Now let's move on to the next middleman in the chain, the distributors. The big wirehouses, banks, broker-dealers, and custody platforms, which are often referred to as financial supermarkets. And it's a good name. But not for the reasons you might think. It applies because they do business a lot like a real supermarket. Just like General Foods pays for shelf space in a supermarket, mutual fund companies pay for shelf space with a distributor. The myth is open architecture, which refers to the thousands of independent and objective investment choices they offer. The reality is pay-to-play, whereby mutual fund companies make payments to the distributors with the explicit understanding that these payments purchase a preferred position among the distributor's product offering. This is called revenue sharing in industry jargon. The most visible example of pay-to-play is Edward Jones, one of the nation's largest broker-dealers with over 10,000 advisors and more than 7 million clients. Because their revenue sharing was so excessive, they were sued by their own clients in a class action suit that covered sales from 1999 through 2004. As part of the settlement, they were forced to prominently show the revenue sharing arrangements and the class action suit on the home page of their website. Pretty interesting reading if you have the time. With all those advisors and clients, mutual fund companies are eager to sell through Edward Jones. And Edward Jones has selling agreements with thousands of funds, which is why they refer to themselves as an open architecture platform. But Edward Jones had a special arrangement with 7 fund families, designated as preferred fund families. Edward Jones training programs provided information only on those preferred families. Advisor bonuses were key to the sale of those 7, and they also paid for advisor boondoggles with cruises, ski trips, and even African safaris. A question: of all the funds sold, what percentage went to the 7 preferred families as opposed to the thousands of other funds on the open architecture platform? How about 98%? But there was a class action lawsuit. Edward Jones lost. So what happened in 2005, the year after the suit? It's business as usual. Edward Jones collected $172 million in revenue sharing, which was equal to 1/3 of its pre-tax revenue. And now you know why, when a financial services company gets caught screwing their clients and settles, they always do it without either admitting or denying any wrongdoing. That is so they can go right back and do it again. Now let's look at the big custodians who custody assets for the clients of smaller broker-dealers and registered investment advisors. One of the biggest is Charles Schwab, always promoting Source One, their commission-free platform. Thousands of funds that you won't pay a penny to purchase. And this is true, but only in the sense that you don't see it. What you don't see is that Schwab extracts undisclosed fees from the fund companies for acting as a middleman, 0.4% on assets and $20 per account per year. And what this does is put upward pressure on the expense ratios, which are then paid by investors. No preferred list. Everyone pays. It's all legal, everyone does it, and the dollars are huge. These ill-disclosed compensation arrangements demonstrate that brokerage firms, banks, and custodians are more interested in doing business with funds that pay them well, as opposed to funds that perform well for their clients. Now let's look at how sheer size works to their advantage, how they use the client assets they gather to make themselves as opposed to clients rich. The most common example is the sweep account, where they warehouse cash distributions from client investments. Schwab had an excellent year in 2006, earning $785 million in profits from their core business of trading and commissions. The average daily balance in their client sweep accounts was $17.9 billion, on which they paid clients an average return of 2.4%. Schwab then took $10.25 billion and used it to make margin loans to their clients, who paid an average rate of 8.2%, a spread of almost 6%. Let's assume they invested the remaining $7.6 billion in 30-day treasuries, which earned an average of 4.8%, Another spread, almost 2.5%. They made $775 million on money they borrowed from and loaned to their own clients, which matches almost dollar for dollar the $785 million they made from trading. The last link in the chain, and the one that is closest to you, the investor, is the advisor. When you deal with an advisor, you want them to be representatives of you, the buyer. You're looking for objective advice. But more and more, they are becoming representatives of the distributor. Here's why. As the markets have and continue to be more and more difficult to manage, so has delivering high-quality, independent, objective advice. Advisors have come to realize that doing real in-depth investment research and building your own portfolios is increasingly more difficult, not to mention expensive and time-consuming. And that's why most advisors no longer even try. By next year, it is estimated that 75% of all advisors, that's over 400,000 advisors, will use funds and portfolios that are centrally selected by their distributors, not advice givers at all, but resellers of marked-up, prepackaged solutions they get directly from their distributors. The same distributors that are deep into pay-to-play. Which funds do you think Edward Jones is recommending? This is why I said, in most ways, the advisor is the real client of the asset management companies, who all want the attention of those 500,000 plus financial advisors. And this is the attention they pay revenue sharing for. As we saw with Edward Jones, the distributors use pay-to-play money to provide support and services, real estate, office assistance, compliance and legal support, technology, and sometimes even a hard cold cash. And don't forget those fabulous trips. Fund companies and distributors work together, using revenue sharing money to influence the advisor. Quality of the advice? There's little doubt that ill-disclosed compensation arrangements between distributors, fund companies, and advisors can cause investors to receive tainted advice. So with all this going on, do advisors add value? Some do, but it's largely based on their ability to navigate around the conflicts of interest on behalf of their clients. But according to our previous study, which as I said before is just one of many, most do not. From indexes at 61,000, brought down to 35,000 with mutual funds, and now with the help of advisors down to 25,000. Kenneth French, one of our nation's leading financial economists, recently completed a study showing that individual investors pay $100 billion a year. Let me say that again, $100 billion, trying to beat the market in ways that don't work. The retail model demonstrates the pathological mutation that Vanguard's founder referred to. Pay to play for the distributor, preferred access for the asset manager, paid services for the advisors, who then gather the assets. Everyone wins. But what about you? For the reasons we just showed you, and there are many more we didn't, we believe that the retail model is broken. Broken in large part because of the way these guys do business. As I said before, it's all legal, which means you have to give a big nod to Congress and the politicians. And as of yet, there is no indication that anything I just showed you is going to change anytime soon.